Hi, everyone. Today we are live with, this is May Doldelau from yesfinanciallyfree.com, and we are live with Chapter 6 of The Intelligent Investor by Benjamin Graham. And the chapter is titled Portfolio Policy for the Enterprising Investor Negative Approach. As I said, my name is May Doldelau. The blog is yesfinanciallyfree.com. Okay. Now, if you're not on the email list already, go to yesfinanciallyfree.com, put in your first name and your email address, and you will get on the email list, get emails about when I'll be live, what I'll be talking about, and links directly to See Things Live. So very convenient. So I want you guys to have that available for you. If you're on my YouTube channel, just subscribe to the YouTube channel and we will begin. Okay, so yesfinanciallyfree.com, name, email address on the right side. Okay, guys. So why am I talking about this book? Right? I'm doing this book, The Intelligent Investor by Benjamin Graham. This is a book that this teacher, Benjamin Graham, he is the one who taught Warren Buffett, okay, how to invest. And Warren Buffett is extremely successful. And right now the market is down. Everybody's like, it's the best time to invest. But do you want to do it wisely and make a lot of money, or do you want to do it like a speculator or a gambler and just lose more money than you could think of? So to me, I'd rather do it wisely. I want to be intelligent. I want to be an intelligent investor. I've never read this book, and I've done a lot of investing that is not so intelligent. So I decided, why not learn from someone who's really good at what they did when he was alive and figure out how to do it the smart way. So that's why I'm reading this book. Now, who am I, right? Who am I to read this book, and who am I to have this blog? My name, like I said, is May Doldelau. I live in Honolulu, Hawaii with my son, Jordan, who's 6 years old now, and my husband, Jamel. And when I started this blog, I was not actually very good with money. I started getting good with money, but I wanted to keep going and become financially free. So I started this blog, and a lot of what I was learning at the time was pay yourself first, right? Invest for passive income. Focus on what you want to increase, like your net worth and your passive income. Don't focus on what you don't want, like debt or financial problems. And do affirmations and, read, research, learn new things. So I just did these basic things. I learned these from mentors. I took courses. I did all kinds of stuff. And I went from I had negative 41,000. That wasn't my net worth. My net worth was like negative 30,000, but I had over $40,000 of debt in 2011 from over 8 different credit cards and lines of credit. And that has nothing to do with a house. I didn't own property. I didn't have collateral. This was all personal debt. Now, I ended up paying it all off by April of 2016, quit my job, increased our family's net worth by $500,000. And I was working as a banking assistant, guys. All right. I didn't have this high prestigious lifestyle or anything. I was a banking assistant. So I made like $35,000 a year. All right. That's before taxes were taken out. Okay. So I went from having all this debt to having no debt, able to quit my job, making passive income almost $500 a month, every month. And I started coaching Finance Freedom Mastermind. So I continued blogging, yesfinanciallyfree.com. And then I added a component where I train and mentor clients who want to become financially free, who want to create passive income while paying down debt, who want to go from really bad with money to much better with money. In 2017, we bought our first property in Waikiki together. In 2018, we bought our second property together, our first investment property together. 2019, we sold our first property to buy this one, which is a condo that we live in Waikiki. It's a larger, bigger, nicer condo. So we're upgrading our lifestyle as we go along, upgrading our wealth as we go along, and upgrading our passive income. So that's where we stand right now. And I'm reading this book to enhance my knowledge, and I like to bring other people up with me. So if you're someone who wants to be financially free and you want help, I am here to help you, okay? And it doesn't matter what your financial situation is like. So go to the blog, yesfinanciallyfree.com. If you're worried, like you're suffering from anxiety, hi, V2 Travel, welcome to the live. If you're suffering from anxiety over your finances, yesfinanciallyfree.com, which is my blog, has blogs to help you get over fears and anxieties. A lot of that is your mental state. Yeah, you have thoughts in your head that are not helpful for your finances, like you're worrying about things, which is not helpful. So there's affirmations there you can practice. There's subconscious videos to program your subconscious for wealth. Those things will help you get over the anxiety. Now, if you're not anxious, which is a good thing, like me, if you're like me and you're wanting to learn more so you can take advantage of a down market or learn how to profit in any kind of market, then there's also a lot of blog posts on there. I highly recommend you check out the All Seasons portfolio by Ray Dalio. I've invested my son's money in that portfolio, and it was made, last time I checked, which was like a week ago, he had made 2.6% on his portfolio during this entire market crisis where everyone's stocks are down, right? Because he's not invested in only stocks. He's doing the All Seasons portfolio, which is mostly bonds. Hi, Astia Stringer. Alicia, hi, what's up? Welcome to the live. I recommend you go to yesfinanciallyfree.com and look into the All Seasons portfolio if you want to put your money somewhere and you're not sure how. I've been constructing one for my husband now for his Roth IRA account. So these are things that I've learned along the way, and I keep learning and growing. And I want you to learn and grow with me because I want you to be able to do the same thing I do. Now, how can you measure your progress? I measure my progress by checking what is my net worth, what is my passive income generation, how am I doing financially, and that's how I can tell if I'm improving. And it's really easy to tell. A lot of us, when we're in financially desperate situations, we're afraid to look at our money. We're afraid to count it. We're afraid to see how much we owe, how much we have. And that is not going to help you. And so I'm here to help you overcome that fear so that you can learn to become wealthy and learn to take control of your money in a way where you can grow it and prosper and feel good, even during these huge market downturns, to feel stable and to feel like you can do this and you can become wealthy, you can become rich. All right. So today we're going to read chapter 6. So that's my story in a nutshell. If you want to learn more about me, go to the blog, get on the email list. So let's begin. Okay, chapter 6. Oh, by the way, this is actually a library book. If you are concerned about money and you don't have enough money, you can always borrow books from the library, guys. You don't have to spend money to read books. And there's a lot of books online. If they're old enough, they're free books because the authors passed away and they're just old enough, so they become free domain. You can find a lot of good materials online. So money is not an excuse for lack of education. Okay, guys? Now, it just so happens that the libraries are closed in Hawaii now, so we can keep our library books until they open again. So I don't have to worry about returning it. Anyway, chapter 6, portfolio policy for the enterprising investor, negative approach. The aggressive investor should start from the same base as the defensive investor, namely a division of his funds between high-grade bonds and high-grade common stocks, bought at reasonable prices. He will be prepared to branch out into other kinds of security commitments, but in each case, he will want a well-reasoned justification for the departure. There is a difficulty in discussing this topic in orderly fashion because there is no single or ideal pattern for aggressive operations. The field of choice is wide. The selection should depend not only on the individual's competence and equipment, but perhaps equally well upon his interests and preferences. The most useful generalizations for the enterprising investor are of a negative sort. Let him leave high-grade preferred stocks to corporate buyers. Yeah, I learned that yesterday. Preferred stocks are for corporate buyers. I was like, oh, I didn't know that. But anyway, let him also avoid inferior types of bonds and preferred stocks unless they can be bought at bargain levels, which means ordinarily at prices at least 30% under par for high coupon issues and much less for the lower coupons. Hello, nice to see you. Where are you from, V-Travel? He will let someone else buy foreign government bond issues even though the yield may be attractive. He will also be aware of all kinds of new issues, including convertible bonds and preferreds that seem quite tempting, and common stocks with excellent earnings confined to the recent past. For standard bond invest. Oh, Houston, nice to see you. We're reading this book. And I've been reading it every day at 8:30 this time. Yesfinanciallyfree.com. If you go there, I have a blog post with all the replays of each chapter. But we're on chapter 6 today, so thank you for joining. Yeah? Okay. Let's see. Houston. What's the weather like in Houston? We've got Texas. 2 Texas people. Oh, Vincent, it's you. Hi, Vincent. You're both on. You're so funny. Okay, I'm going to keep reading. Seem quite tempting. Okay. For standard bond investments, the aggressive investor would do well to follow the pattern suggested to his defensive confrere. Jeez, so funny. The words in here are so old. Confrere, and make his choice between high-grade taxable issues, which can now be selected to yield about 7.25%, and good quality tax-free bonds, which yield up to 5.3% on longer maturities. Love you too. Second grade bonds and preferred stocks. Since in late 1971, it is possible to find first rate corporate bonds to yield 7.25%, and even more, it would not make much sense to buy second grade issues merely for the higher return they offer. In fact, corporations with relatively poor credit standing have found it virtually impossible to sell straight bonds, non-convertibles, to the public in the past 2 years. Hence, their debt financing has been done by the sale of convertible bonds or bonds with warrants attached, which place them in a separate category. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus, they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and lower general interest rates. Well, hold on a second. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus, they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and generally lower interest rate. Okay. But even in the matter of price discounts and resultant chance of principal gain, the second grade bonds are in competition with better issues. Hi, Trav Reagan. What's up? I like all your posts, by the way. You got a lot of cool posts. Very inspiring. We're reading this book. I read this book every day at 8:30 a.m. Okay, we're on chapter 6, if you didn't know. And yesfinanciallyfree.com is where you can see all my replays and everything all together. So get on my email list. All right. Where am I? Dun, dun, dun. Okay, I'm going to start right here. But even in the matter of price discounts and resultant chance of principal gain, the second grade bonds are in competition with better issues. Some of the well-entrenched obligations with old-style coupon rates, 2.5% to 4%, sold at about 50 cents on the dollar in 1970. Examples, AT&T, 2.58, due 1986, sold at 51. Atchison, Topeka, and Santa Fe Railroad 4s, due 1995, sold at 51. McGraw 3.78, due 1992, sold at 50.5. Hence, under conditions of late 1971, the enterprising investors can probably get from good grade bonds selling at a large discount all that he should reasonably desire in the form of both income and chance of appreciation. Throughout this book, we refer to the possibility that any well-defined and protracted market situation of the past may return in the future. Hence, we should consider what policy the aggressive investor might have to choose in the bond field if prices and yields of high-grade issues should return to former normals. For this reason, we shall reprint here our observations on that point made in the 1965 edition, when high-grade bonds yielded only 4.5%. Something should be said now about investing in second-grade issues, which can readily be found to yield any specified return up to 8% or more. The main difference between first and second-grade bonds is usually found in the number of times the interest charges have been covered by earnings. Example, in early 1964, Chicago, Milwaukee, St. Paul, and Pacific 5% income debenture bonds at 68 yielded 7.35%, but the total interest charges on the road before income taxes were earned only 1.5 times in 1963 against our requirement of 5 times for the well-protected railroad issue. Many investors buy securities of this kind because they need income and cannot get along with the meager return offered by top-grade issues. Experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here, the word merely implies that the issue is not selling at a large discount and thus does not offer an opportunity for a substantial gain in principal value. Where such securities are bought at full prices, that is, not many points under 100, the chances are very great that at some future time the holder will see much lower quotations. For when bad business comes, or just a bad market, issues of this kind prove highly susceptible to severe sinking spells. Often interest or dividends are suspended or at least endangered, and frequently there is pronounced price weakness even though the operating results are not at all bad. So I actually have personal experience in this. I've had stocks where they've stopped dividends. And hi, Venturesome, where are you from? Thanks for being on. What's your name? Oh, we're reading this book. Okay. As a specific illustration of this characteristic of second quality senior issues, let us summarize the price behavior of a group of 10 railroad income bonds in 1946 to 1947. These comprise of all those which sold at 96 or more in 1946, their high prices averaging 102.5. By the following year, the group had registered low prices averaging only 68, a loss of 1/3 of the market value in a very short time. Peculiarly enough, the railroads of the country were showing much better earnings in 1947 than in 1946. Hence, the drastic price decline ran counter to the business picture and was a reflection of the sell-off in the general market. But it should be pointed out that the shrinkage in these income bonds was proportionately larger than in the common stocks in the Dow Jones Industrial List, about 23%. Obviously, the purchaser of these bonds at a cost above 100 could not have expected to participate to any extent in a further rise in the securities market. The only attractive feature was the income yield, averaging about 4.25%, against 2.5% for first-grade bonds, an advantage of 1.75% in annual income. Yet the sequel showed all too soon and too plainly that for this minor advantage in annual income, the buyer of these second-grade bonds was risking the loss of a substantial part of his principal. Well, it's better to read this late than never, right, guys? The above example permits us to pay our respects to the popular fallacy that goes under the sobriquet of a businessman's investment. That involves the purchase of a security showing a larger yield than is obtainable on a high-grade issue and carrying a correspondingly greater risk. It is bad business to accept an acknowledged possibility of a loss of principal in exchange for a mere 1 to 2% of additional yearly income. If you are willing to assume some risk, you should be certain that you can realize a really substantial gain in principal value if things go well. Hence, a second-grade 5.5 or 6% bond selling at par is almost always a bad purchase. The same issue at 70 might make more sense, and if you are patient, you will probably be able to buy it at that level. Second-grade bonds and preferred stocks possess two contradictory attributes which the intelligent investor must bear clearly in mind. Nearly all suffer severe sinking spells in bad markets. Do you guys have second-grade bonds or securities that are really down now during this pandemic market? I do. Okay. God. On the other hand, a large proportion recover their position when favorable conditions return, and these ultimately work out all right. This is true even of cumulative preferred stocks that fail to pay dividends for many years. There were a number of such issues in the early 1940s as a consequence of the long depression of the 1930s. During the post-war boom period of 1945 to 1947, many of these large accumulations were paid off either in cash or in new securities, and the principal were often discharged as well. As a result, large profits were made by people who, a few years previously, had bought these issues when they were friendless and sold at low prices. It may well be true that, in an overall accounting, the higher yields obtainable on second-grade senior issues will prove to have offset those principal losses that were irrecoverable. In other words, an investor who bought all such issues at their offering prices might conceivably fare as well in the long run as one who limited himself to first quality securities or even somewhat better. And they have a footnote here. An elaborate statistical study carried on under the direction of the National Bureau of Economic Research indicates that such has actually been the case. And then he has another example here. Cities Service $6 first preferred, not paying dividends, sold at as low as 15 in 1937 and at 27 in 1943, when the accumulations had reached $60 per share. So buying toilet paper stocks in February could have made you a bundle now. Maybe. In other words, hold on. In 1947, it was retired by exchange for $196.50 of 3% debentures for each share, and it sold as high as $186. So if you see, what he's saying is that if you have second grade bonds or some preferred shares that are cumulative, they could work out to be pretty profitable if you buy them at depression prices. Right now, Ray Dalio says we're beginning a depression. So depression prices are here, guys. So if you buy a preferred or a bond at these, even if they're second grade and they're cumulative at $100 per share and they're exchanging at a loss of as low as like $27, you're going to make a profit on each share as it's cashed out, bought back from you. $67 a share at plus any dividends, cumulative dividends that weren't paid. So if you bought it in 1943 at $27 a share, they would buy it back at $196.50 in 1947. And you could sell the share for $186. Fascinating stuff, guys. There's hope. Okay. But for practical purposes, the question is largely irrelevant. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried and discommoded when their price declines precipitously. So if you're buying second-grade bonds or preferreds, don't buy it at regular price. You have to buy it at a large discount of at least 30%, or you're probably going to lose money. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried. Okay, blah, blah. Furthermore, he cannot buy enough issues to assure an average result, nor is he in a position to set aside a portion of his larger income to offset or amortize those principal losses which prove to be permanent. Finally, it is mere common sense to abstain from buying securities at around 100 if long experience indicates that they can probably be bought at 70 or less in the next weak market. Foreign government bonds. All investors with even small experience know that foreign bonds as a whole have had a bad investment history since 1914. This was inevitable in the light of 2 world wars and an intervening world depression of unexampled depth. So good time to buy bonds if you are okay sitting on it until they come back. As long as it's discounted at least 30% if it's a second grade bond, according to this book. If it's a first grade bond, then you can buy first grade bonds and they're more reliable and you can buy them at regular price. But he's saying if you're buying second grade bonds because they have a higher yield, you want to buy them at least at a 30% discount, because if they're at full price, that wouldn't be good. But right now I see a lot of, I haven't looked at the bond market, so I'm not sure, but I've seen preferred selling at over 50% below their regular price. So it is depression level pricing on preferreds. But he says you shouldn't buy preferreds unless you're a corporation. So that's this book. But he says it for tax reasons, which I don't know if are relevant now in this day and age. I'd have to look up the tax treatment of preferred shares. Yet every few years, market conditions are sufficiently favorable to permit the sale of some new foreign issues at a price of about par. This phenomena tells us a good deal about the working of the average investor's mind, and not only in the field of bonds. We have no concrete reason to be concerned about the future history of well-regarded foreign bonds such as those of Australia or Norway. But we do know that if and when trouble should come, the owner of foreign obligations has no legal or other means of enforcing his claim. Those who bought Republic of Cuba 4.5s as high as 117 in 1953 saw them default their interest and then sell as low as 20 cents on the dollar in 1963. The New York Stock Exchange bond list in that year also included Belgian Congo 5.25s at 36, Greek 7s at 30, various issues of Poland as low as 7. How many readers have any idea of the repeated vicissitudes of 8% bonds of Czechoslovakia since they were first offered in the country in 1922 at 96.5? They advanced to 112 in 1928, declined to 67.75 in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, recovered unbelievably to 117 in 1946, fell promptly to 35 in 1948, and sold as low as 8 in 1970. Years ago, an argument of sorts was made for the purchase of foreign bonds, here on the grounds that a rich creditor nation such as ours was under moral obligation to lend abroad. Time, which brings so many revenges, now finds us dealing with an intractable balance of payments problem of our own, part of which is ascribable to the large-scale purchase of foreign bonds by American investors seeking a small advantage in yield. For many years past, we have questioned the inherent attractiveness of such investments from the standpoint of the buyer. Perhaps we should add now that the latter would benefit both his country and himself if he declined these opportunities to invest in foreign bonds. New issues generally. It might seem ill-advised to attempt any broad statements about new issues as a class, since they cover the widest possible range of quality and attractiveness. Certainly, there will be exceptions to any suggested rule. Our one recommendation is that all investors should be wary of new issues, which means simply that these should be subjected to careful examination and unusually severe tests before they are purchased. There are two reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls therefore for a special degree of sales resistance. The second is that most new issues are sold under favorable market conditions, which means favorable not for the seller and consequently less favorable for the buyer. The effect of these considerations becomes steadily more important as we go down the scale from the highest quality bonds through second-grade senior issues to common stock flotations at the bottom. Tremendous amount of financing consisting of the repayment of existing bonds at call price and their replacement by new issues with lower coupons was done in the past. Most of this was in the category of high-grade bonds and preferred stocks. The buyers were largely financial institutions amply qualified to protect their interests. Hence, these offerings were carefully priced to meet the going rate for comparable issues, and high-powered salesmanship had little effect on the outcome. As interest rates fell lower and lower, the buyers finally came to pay too high a price for these issues, and many of them later declined appreciably in the market. This is one aspect of the general tendency to sell new securities of all types when conditions are most favorable to the issuer. But in the case of first quality issues, the ill effects of the purchaser are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the low-grade bonds and preferred stocks sold during 1945 to 1946 and 1960 to 1961 periods. Here, the effect of the selling effort is more apparent because most of these issues were probably placed with individual and inexpert investors. It was characteristic of these offerings that they did not make an adequate showing when judged by the performance of the companies over a sufficient number of years. They did look safe enough for the most part, if it could be assumed that the recent earnings would continue without a serious setback. The investment bankers who brought out these issues presumably accepted this assumption, and their salesmen had little difficulty in persuading themselves and their customers to a like effect. Nevertheless, it was an unsound approach to investment and one likely to prove costly. Bull market periods are usually characterized by the transformation of a large number of privately owned businesses into companies with quoted shares. This was the case in 1945 to 1946 and again in 1960. The process then reached extraordinary proportions until brought to a catastrophic close in May 1962 after the usual swearing off period of several years. The whole tragic comedy was repeated step by step in 1967 and 1969. I have heard that new issues were selling a lot recently over the last few years. So there's probably been a huge loss of income for that too in this pandemic market. New common stock offerings. The following paragraphs are reproduced unchanged from the 1959 edition with comment added. Common stock financing takes two different forms. In the case of companies already listed, additional shares are offered pro rata to the existing stockholders. The subscription price is set below the current market, and the rights to subscribe have an initial money value. The sale of the new shares is almost always underwritten by one or more investment banking houses, but it is the general hope and expectation that all the new shares will be taken by the exercise of the subscription rights. Thus, the sale of additional common stock of listed companies does not ordinarily call for active selling effort on the part of distributing firms. The second type is the placement with the public of common stock of what were formerly privately owned enterprises. Most of this stock is sold for the account of the controlling interests to enable them to cash in on a favorable market and to diversify their own finances. When new money is raised for the business, it comes often via the sale of preferred stock, as previously noted. This activity follows a well-defined pattern, which by the nature of the securities market must bring many losses and disappointments to the public. The dangers arise both from the character of the businesses that are thus financed and from the market conditions that make the financing possible. In the early part of the century, a large proportion of our leading companies were introduced to public trading. As time went on, the number of enterprises of first rank that remained closely held steadily diminished. Hence, original common stock flotations have tended to be concentrated more and more on relatively small concerns. By an unfortunate correlation, during the same period of the stock buying public has been developing an ingrained preference for the major companies and a similar prejudice against the minor ones. This prejudice, like many others, tends to become weaker as bull markets are built up. The large and quick profits shown by common stocks as a whole are sufficient to dull the public's critical faculty, just as they sharpen its acquisitive instinct. During these periods also, quite a number of privately owned concerns can be found that are enjoying excellent results, although most of these would not present too impressive a record if the figures were carried back, say, 10 years or more. When these factors are put together, the following consequences emerge. Somewhere in the middle of the bull market, the first common stock flotations make their appearance. These are priced not unattractively, and some large profits are made by the buyers of the early issues. As the market rise continues, the brand of financing grows more frequent. The quality of the companies becomes steadily poorer. The prices asked and obtained verge on the exorbitant. One fairly dependable sign of the approaching end of a bull swing is the fact that new common stocks of small and nondescript companies are offered at prices somewhat higher than the current level for many medium-sized companies with long market history. It should be added that very little of this common stock financing is ordinarily done by banking houses of prime size and reputation. The heedlessness of the public and the willingness of selling organizations to sell whatever may be profitably sold can have only one result: price collapse. In many cases, the new issues lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that at bottom, the public has a real aversion to the very kind of small issue that is bought so readily. So good time to buy bonds if you're okay. Keep going. The public has a real aversion to the very kind of small issue that is bought so readily in its careless moments. Many of these issues fall proportionately as much below their true value as they formerly sold above it. An elementary requirement for the intelligent investor is an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Even if one or two can be found that can pass severe tests of quality and value, it is probably bad policy to get mixed up in this sort of business. Of course, the salesman will point to many such issues which have had good-sized market advances, including some that go up spectacularly the day that they are sold. But all this is part of the speculative atmosphere. It is easy money. For every dollar you make in this way, you will be lucky if you end up by losing only 2. Some of these issues may prove excellent buys a few years later when nobody wants them and they can be had at a small fraction of their true worth. In the 1965 edition, we continued our discussion of this subject as follows. While the broader aspects of the stock market's behavior since 1949 have not lent themselves well to analysis based on long experience, the development of new common stock flotations proceeded exactly in accordance with ancient prescription. It is doubtful whether we ever before have had so many new issues offered of such low quality with such extreme price collapses as we experienced in 1960-1962. The ability of the stock market as a whole to disengage itself rapidly from that disaster is indeed an extraordinary phenomenon. Bringing back long-buried memories of the similar invulnerability it showed to the great Florida real estate collapse in 1925. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in 1962 and will let others make the next batch of quick profits in this area and experience the consequent harrowing losses. We followed these paragraphs in the 1965 edition by citing a horrible example, namely the sale of stock of Aetna Maintenance Company at $9 in November of 1961. In typical fashion, the shares promptly advanced to $15. The next year, they fell to 2 3/8, and in 1964 to less than $1, 7/8. The later history of this company was on the extraordinary side and illustrates some of the strange metamorphoses that have been taken in American business, great or small, in recent years. The curious reader will find the older and newer history of this enterprise in Appendix 3. It is by no means difficult to provide even more harrowing examples taken from the recent version of the same old story, which covered the years 1967 to 1970. Nothing could be more pat to our purpose than the case of AAA Enterprises, which happens to be the first company then listed in Standard & Poor's Stock Guide. The shares were sold to the public at $14 in 1968, promptly advanced to 28, but in early 1971 were quoted at the dismal 25 cents. Even this price represented a gross overvaluation of the enterprise since it had just entered bankruptcy court in a hopeless condition. There is so much to be learned and such important warnings to be gleaned from the story of this flotation that we reserved it for detailed treatment below in chapter 17. Okay, they had one footnote. A representative sample of 41 such issues taken from Standard & Poor's Stock Guide showed that five lost 90% or more of their high price, 30 lost more than half, and the entire group about 2/3. The many not listed in the stock guide undoubtedly had a larger shrinkage on the whole. So the moral of the story is do not buy new issues because they will go down in price drastically. Okay, we're done with chapter 6. So thank you again for being on. We will do chapter 7 tomorrow. And I'm excited. I'm learning things every day from this book. It is an older book, but it's showing the recurring patterns of human behavior in the stock market. And I understand everything it's saying from personal experience. Sometimes you have to learn the hard way. So I hope you guys are learning the easy way. I'm learning the hard way, it seems, learning after the fact. So this was a reading of chapter 6 of The Intelligent Investor by Benjamin Graham, Portfolio Policy for the Enterprising Investor, Negative Approach. My name is May Duldelau, and the blog is yesfinanciallyfree.com. So if you're not on the email list yet, go there, put in your first name and your email address, and subscribe. You will get a free ebook, Working Parents Guide to Financial Freedom. And if you go there on the products page, you can see all the services and products I offer my clients. It's as low as, well, if you join the email list, you get a free ebook, Working Parents Guide to Financial Freedom. So you can get a free product right there. You can go as high as $5,000 for our hand-holding mastermind program where we take you through every week steps toward becoming financially free. We help everyone in the mastermind become financially free as fast as possible. We do that live every week on an online course mastermind program with limit to 10 people on each mastermind group. And then you have a 1-hour office hour every week where you can ask any questions. And you also get a private coaching session with a financial freedom coach once a month if you need it to track your net worth, passive income, financial freedom account, and cash flow. And you get invited to the annual Christmas party in Hawaii. Have a great day, guys. I appreciate you, and I'll see you again tomorrow. Aloha. Bye. Subscribe to the YouTube channel if you haven't already, and you will get email reminders when I'm live. See ya.